Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about TILRAY Brands Inc. quarterly report. TILRAY Brands Inc. offers a diverse range of products and services across various segments. The company's beverage segment includes brands such as Montauk Brewing, Shock Top, and Breckenridge Brewery, which produce and market beverage products. In the cannabis segment, TILRAY provides medical and adult-use cannabis products under several brands including TILRAY, Aphria, and Charlotte's Web. The distribution segment involves reselling and distributing pharmaceutical and wellness products to retailers, wholesalers, and governments. The wellness segment includes hemp-based food products from brands like Manitoba Harvest and CC Pharma. Additionally, the company offers entertainment products through its various brands. Some of the notable brands under TILRAY Brands include Good Supply, Solai, Malo, and Chowie Wowie. TILRAY Brands also operates in the medical cannabis space with brands such as TILRAY Medical, Bake Sale, and The Batch. Furthermore, the company has expanded into the beverage market through its acquisition of several breweries, including Breckenridge Brewery, Sweetwater Brewing Company, and Terrapin Beer Co. Overall, TILRAY Brands offers a wide range of products across various categories, catering to different markets and consumer needs. TILRAY Brands Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $3 billion. TILRAY Brands Inc. trades at a lower price-to-book ratio of 0.45 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 28% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be summarized into several key points. On the growth side, the acquisition of Brewdog UK Ltd's business operations and assets contributed £33,000 to revenue. Additionally, growing demand for medical cannabis products in international markets, branded business growth across brick-and-mortar retail and e-commerce, and positive developments regarding cannabis rescheduling in the U.S. all contributed to revenue growth. The beverage segment saw a 12% increase in revenue at 3 months and 15% at 9 months, while the distribution segment experienced an 18% increase at 3 months and 22% at 9 months. The wellness segment also grew by 10% at 3 months and 13% at 9 months. In Canada, there was a $2.7 million increase in traditional pre-rolls and a $1.7 million increase in whole flower sales. On the decline side, uncertainty resulting from changes in U.S. global economic policy contributed to revenue decline. The beverage segment experienced a decline due to industry-wide challenges, broader competitive pressures, and margin-focused actions. Canadian medical cannabis saw a decline due to uninsured patient attrition to the adult-use recreational market. Additionally, lower gross margin due to craft acquisition declining overhead utilization, higher input costs, timing delays in cost savings initiatives, and increased discounting also contributed to revenue decline. The net income and profit margins of the company underwent significant changes over the past year. In Q4 2025, the net income decreased by $22,222 compared to Q3 2025, while in the 3 months ended February 28, 2026, the company reported a net loss. The 9-month period also saw a net loss. Profit margins also experienced fluctuations across different segments. In Q4 2025, the overall profit margin decreased from 18.2% to 15.6%. However, some segments showed improvement, such as distribution and wellness, while others remained consistent or declined slightly. The beverage segment saw a decrease in profit margins, but the cannabis segment maintained its consistency. The reasons behind these changes are varied. In Q4 2025, no specific reason was provided for the decline in net income and profit margins. However, in the subsequent periods, factors such as gains from changes in fair value of warrants and foreign exchange rates contributed to improved profit margins, but were offset by losses on long-term investments. These mixed results indicate that the company's financial performance is influenced by a range of factors, both positive and negative. And the company is indeed generating positive operating cash flow, a crucial indicator of its financial health. According to the provided information, for the 3-month period ending February 28, 2026, the company generated an impressive $3.4 million in operating cash flow. Furthermore, when looking at the 9-month period up to the same date, the company's operating cash flow reached a significant $11.1 million. It is worth noting that this figure excludes changes in working capital, which suggests that the company's core operations are generating substantial cash inflows. This trend indicates a strong ability of the company to cover its expenses and invest in growth initiatives, ultimately contributing to its overall financial stability. The company's debt level and interest expenses have undergone significant changes in recent years. A notable increase in long-term debt was observed from $1 in 2025 to $1 in 2026. This upward trend is a cause for concern, indicating that the company may be taking on more financial obligations. Furthermore, the principal amount outstanding decreased, but specific figures are not provided. Despite this decrease, the overall debt level has increased, suggesting that the company's debt burden remains substantial. The interest expenses have also seen a significant increase from $3 months ended February 28, 2025, to 3 months ended February 28, 2026. Additionally, accretion of amortized discount interest rose from 9 months ended February 28, 2025, to 9 months ended February 28, 2026, indicating a higher financial strain on the company. The global cannabis industry has shown a mixed performance across various regions and segments. On the positive side, Germany, Portugal, and Luxembourg have been standout performers, indicating strong demand for cannabis products in these markets. In terms of growth potential, Ireland and Italy are emerging as promising regions, with opportunities for expansion and development. However, other regions such as Poland, the United Kingdom, and Australia face challenges that hinder their growth. Looking at specific segments, branded businesses, North America, Asia, the UK, Europe, Canadian adult use cannabis, and international cannabis have all performed well. In contrast, Canadian medical cannabis, wholesale cannabis, and the beverage segment have struggled to keep pace with demand. These findings suggest that while some regions and segments are thriving, others require attention and investment to overcome their challenges. Management is optimistic about the company's future prospects, citing several key areas of growth and expansion. The spirits segment is expected to experience sustained growth due to a focus on whiskey and innovative product introductions. Internationally, the company is well positioned to maintain and gain significant market share thanks to its vertically integrated infrastructure and expertise. The company also aims to drive leadership in international medical markets and successfully enter new markets as they adopt medical cannabis regulations. In addition, management plans to continue growing the branded business across brick-and-mortar retail and e-commerce. To achieve these goals, the company will pursue a combination of organic growth and strategic acquisitions. Management is confident that existing cash reserves, marketable securities, digital assets, and operational cash flow will be sufficient to meet both short-term and long-term capital needs. The focus is on generating positive cash flow from operations and achieving free cash flow positivity. Overall, the company's strategy is centered around driving growth, expanding its presence in key markets, and maintaining a strong financial position. The company has made several strategic moves in the form of acquisitions and divestitures. In terms of acquisitions, the company has purchased Montauk Brewing Company for a contingent consideration payment of $18 million. Additionally, it has acquired Craft Acquisition I&II, as well as the assets of Brewdog US. These acquisitions are expected to bring new products and brands into the company's portfolio, potentially expanding its market share and customer base. On the other hand, the company has also made divestitures, including a reduction in distribution goodwill through impairment charges. This move is likely aimed at streamlining operations and reducing costs. The company's financial history reveals a consistent practice of paying dividends to its shareholders. This indicates a commitment to rewarding investors through direct returns on their investment. On the other hand, there is no evidence to suggest that the company has engaged in share buybacks, which would involve repurchasing existing shares from the market. That concludes the financial summary for Tilray Brands Inc. Feel free to comment below, and I will be happy to answer them when possible.